Need to get something off your chest? Call Focus on the Downs, 13 27 10. 13 27 10. On 864 4GR.
The information supplied on this program does not consider your personal circumstances and is general advice only. You should not act on any recommendation without considering your personal needs, circumstances and objectives. Retire Invest recommends you obtain professional financial advice specific to your circumstances. Jeff English is an authorised representative of RI Advice Group Proprietary Limited.
22 to 1 now, Jeff. Thank you for coming in, and I do appreciate you came in the day after the budget, and we sort of touched on a few changes to superannuation which could impact on quite a few of our listeners.
There's a lot there.
Yeah, there is. And I thought we might just go back and talk about some of the main ones again, because there is some more information that's come out. The new cap of $1.6 million superannuation to pension transfer cap. It was interesting last night. I was watching Q&A for a little bit, and the question was asked of the audience, how many of you would have that much money in superannuation? And only, I think, one person put their hand up. So it would be fair to say that this is not going to affect the majority of people with money in super.
No, they've estimated about 4% of superannuation fund members will be affected immediately. I think it's also, if you consider the long-term effects, yes, there will be some indexation, but I think that people will potentially catch up to that cap over time, because we're putting more and more money into super at the moment, as time goes on. So there's been quite a lot of confusion around the proposal as well, Graham. So this sort of lifetime cap starting at 1.6 million, it's from the 1st of July 2017. So if you've got a pension balance above that 1.6 million, and that's a per person balance, you'll either have to withdraw the excess, put it in the bank, for example, or transfer that excess back into superannuation accumulation phase where it will be taxed.
Right.
So that's the issue there. And one thing that comes to mind, of course, is for people that have different styles of assets. For example, they might have a rental property or a commercial property in a fund, or they might have shares in other parts of the fund. They'll have to consider what assets go back to super to be taxed and what assets stay in the tax-free environment, because that'll have a very different effect on managing the tax outcomes.
Okay. The other issue is that you've always been able to claim a tax deduction for superannuation contributions.
Yes.
Okay.
Well, not always, but you have to meet criteria.
Yeah. But it used to be up around about $30,000, wasn't it?
35 for over 50s, 30,000 for under 50s.
Right.
Yes, so proposal down to 25 for everybody.
Oh, okay.
So limiting our ability to put money into superannuation at the level that we currently have, and that there's also the non-deductible cap where they've brought that retrospective cap in to say you can only put $500,000 into super and not claim a tax deduction. Versus the current $180,000 a year, or $540 in 1 year, which is like basically a 3-year bring forward. So they're putting that $500,000 cap, and they're basically testing it back to July 2007. So if people have already put more than that into superannuation, they won't be penalised or made to take money out. They just won't be able to put any more in. So that's on the non-deductible side. On the tax-deductible side, a reduction to $25,000 per annum.
Under the current system, as I understand it, people aged 65 or older need to satisfy what's called a work test to be eligible to contribute to super. Has that changed?
Up to age 75, yes. So they're proposing to scrap the work test, which basically means that at the moment, if you were working at least 40 hours in a consecutive 30-day period, you would meet a work test to put money into super. You won't have to do that anymore. It's a simplification. So at the same time, they're also proposing that you don't need to be self-employed or an employed person to get a tax deduction for personal super contributions. So they are making super simpler at that level. Basically, if you if you're under 75, you're able to put money into super, subject to the caps, and potentially claim a tax deduction as well.
Right, so that's a positive to come out of it.
Yes.
Okay. Just finally, transition to retirement schemes, are they still worthwhile after Tuesday night?
Well, Graham, this was a little bit of a bolt from the blue. So they've actually proposed to tax the pool of money that's used to create a transition to retirement pension. At present, if you've got $300,000 in a transition to retirement pension, the income that's derived from that pool of money is taxed at 0%. and potentially, depending on your age, the money coming out in pension dollars into your bank is also tax-free or tax-advantaged. So they've basically said, we are now going to tax the pool of money like it's superannuation at 15%. So yes, the short answer is it's still worthwhile, but it's very much an individual thing now. So it may be of minimal benefit from the middle of next year, depending on whether that proposal becomes legislation.
Yeah, I know. They are fairly significant changes that have been made, though, right across the board.
Well, if you couple that with a salary sacrifice strategy, where all of a sudden you're not getting any tax benefit on the pool of money and you can put less into super of the money you're taking out, it may not be of any benefit to an individual.
Best to talk to a financial advisor, I would suggest, and you can do that by calling the gang at Retire Invest on this number, 4639 3733. 4639 3733. You can make an appointment with any of the financial advisors at Retire Invest, and they should be able to point you in the right direction. Thanks for coming in. We do appreciate it, Jeff. And Steve for giving us the market report. It's now 17 to 1.